Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook. All right, so busy week in the markets as we usually have. So here we are on Friday. On Wednesday, we did a speculative trade on Adobe. Kind of was hoping that we'd see a little bit of the pattern that we had saw in NVIDIA, and I would say that really did happen. Adobe had a very solid run up going into earnings, just like a lot of the stocks that have been tagged with the AI moniker, I should say. And it's amazing to me when I do, even though we talk a lot about the expected move and what the marketplace is pricing in, but I find it odd when that move actually has a tendency to happen right after the earnings announcement. Now, I've mentioned this a couple of times that when you're looking at the expected move, let's define it, right? The expected move is if you look at buying a long call and buying a long put right where the underlying stock is at, and you use the shortest term expiration. A lot of times people will use that as a reference to how much the marketplace, and that's the vernacular that they use, is expecting the stock to move after they announce earnings. Now, what they don't tell you about that is that if you're using option contracts that expire, so let's say they announce on a Monday, the nearest term expiration would be Friday in most cases on individual stocks. So that expected move actually covers the whole week. And a lot of times, though, it seems like we will peg the expected move or come very close to it almost instantly after a company announces earnings and the stock starts trading. And that happened in Adobe Systems, and that's why I'm going down this road, if you will. But Adobe announced on Thursday you're using the Friday options. Well, the expected move is obviously to the expiration of those Friday option contracts. So it's not an exact science, I guess, is the moral to my story. A lot of reporters, a lot of the financial stations just want to have a talking point, and a lot of times they just don't really realize what they're talking about, except for that they understand that the expected move is an interesting point. And it is interesting. You're looking at what the marketplace is willing to pay for a call and a put, and if they think it's going to move more, they're going to be willing to pay more, right? And it never has any regard to direction because once again, you're buying the call, you're buying the put, and it's a way to look at it. I like to reference it as the over under on a football game. We're in football season right now, so whenever you see the total score, let me think of right around, let's say this team A is playing team B and the total score is 50 points between both the teams. Do you want the over or do you want the under? Do you think it'll be over 50 points total, or do you think it'll be under 50 points total? And that's kind of the way that I look at the expected move around earnings on individual stock. Okay, so I have Adobe up. Let's go and take a peek at it right now. And you'll see that I'm looking at my numbers, and we did the numbers on Wednesday, but fortunately, the stock closed on Thursday very close to where the stock was on Wednesday. And they always, on Options Guide TV, we do it at 11 o'clock Eastern time. So I would have probably set the trade up on Thursday, but it would have been very similar because the stock closed very close to where the stock was when we were talking about it on Wednesday. Okay. But the expected move at that point in time was $29.40, or around 5%. And a lot of times the reporters and the financial news, they'll just say the expected move is 5% after earnings. So on the open, the stock actually, when we set up our strike, so I'm highlighting this on our screen now, Adobe's at 525. Right now it's down $26 on the day, but it came down, and the low for the day, let me flip the page, was 526. Oh, now it looks like it's even below that, isn't it? 525. So now we're below that. So we're down 27 points, and the expected move was 29. So I mean, I would call that a win, I guess, as far as the expected move is concerned. When you get it that close, and on the open, the low on the open was 526.26. That was the low on the open. So very, very close to the expected move right on the opening print of the underlying stock within the first half hour. Okay. So what does that mean with our trade? Well, we looked at a butterfly. We went beyond the expected move out of the money. We were hoping that it would go a little bit more than that, and we didn't quite get our wish, but we came close. And because of that, our trade is going to work out this week. And the trade that we put on is we bought the 520, and I guess I have it all set up here. So let me just scroll down and highlight a little bit. This is one of the beautiful things of the Trade Hawk options grid is that we have a little column that says spread, and it shows you the legs. And then if we look down here, we can actually see it inside the order ticket. So 525 is the option, the put option that we bought. We decided that we were going to get negative on the underlying stock. The 505 is the one that we sold. So we sold two of those to create a butterfly. And then our protection was the 485. We bought the wing. That was our protection. Stock came down to 525. We got a week remaining in this underlying. We got 7 days remaining until that expiration date. So now you have a decision. Personally, when it came down on the open to right around 520, 526.26, I probably would have gotten out of the trade. If I had more than one on, let's just say we had two of these trades on, I wouldn't want to go in my own account. I wouldn't be doing like a 10 lot because this is such a speculative trade. And if it would have went 30 points the other way, well, you're out, you're done. There's no adjustment you can really make on that trade. But I might have done two of them or maybe four, somewhere in that range, depending on where your risk tolerance is, the size of your account, everything that you wanted to spend on that. And we paid $2 for it. As a matter of fact, we paid $195, and we did the September 22nd expiration. You can see right now, the market is actually moving in the right direction. It's 425. And a lot of times when I'm looking at a butterfly, I'm very happy to double on that trade, especially if I'm going out a little bit longer in time. So in this instance, we went out 7 days. We gave it a little bit of time to play out. That also allows us to do an adjustment on the trade if we wanted to. But if I'm doing a butterfly around earnings and there's only 1 day remaining to expiration, I like to look at that real near-term option contract, because if it does get down to your strike, down to the 525 level, basically every point that got in the money, 524, 523, 522, with only 1 day remaining, you're going to have an extremely high delta on that butterfly. And every point movement, you're going to get a good chunk of that point movement. So you would look at the position delta on the butterfly, and this 505 would wither away with every half hour there is in the trading. And in order for a butterfly to max out, you need your middle strike to basically disappear. You need all the time value, all the implied volatility to come out. And that can happen when you have a stock like Adobe that's going to be announcing on a Thursday and you have 1 day remaining. Okay. Our trade is actually doing a little better than if we did the shorter term trade. Why? Because we're at 525.86. We're not at 425.86. We're not in the money on that option contract. And on Options Guy TV, all these things are paper trades, and we're really trying to learn. The biggest thing that I love about butterflies is it tells you a lot just about how options are priced and why they're priced the way they are. So I like to look at different butterflies in different time periods. Okay. I'm getting a little long-winded on this trade, but we've done a few butterflies on here and actually worked out pretty well. You want to make sure that you're really managing your risk, but also you need to understand that we're doing a 20-point wide butterfly. If you make 20 points on it, which would be $2,000, meaning you could sell it for $2,000 minus whatever you got in it, you really should get the stupid award for that. And bluntly, just sticking around all the way to the end when the stock comes down and hits the 505 strike is really just not worth it. So it's a little bit of a joke to me to say that you get the stupid award. You would have hit a home run on the trade, but ideally you should have been out of it. And if you have a realistic expectation on how that butterfly is going to decay over time when you're correct on your forecast, you would know that, oh my gosh, if I paid $2 for it and I can sell it for 4 or 6 on a 20-point wide butterfly, I want to get out. And so I have a realistic expectation on what I can make on the upside and understand that that butterfly, I need that middle strike to just go away. So if we go to the 0-day, and this is the chain, here's how the option grid works. Over here, we're highlighting that expiration. It's highlighted up here. Here's the trade that we did. Now I'm going to leave that there, but I'm going to go down to the order ticket and I'm going to change things up. So the easiest way to just adjust this so that it goes down to the 0-day, which means the rest of the day trading, the September 15th expiration, I am going to just move it right here. So I'm going to click this little arrow, this little caret, and I'm going to go to the 15th, and I'm going to move this one to the 15th, and then move this one to the 15th. All right. And you see that that's trading for $2 at this point in time. And that was basically what we paid for it. If my notes were correct, I think we paid somewhere around $2 for that trade. I don't know exactly. I have to go back and relook. I'm kind of being skeptical of what I'm seeing in my notes, but now it's trading for exactly that. So you would be right on the forecast and you would be getting out at about break even, but the potential is there. Right? You still have the rest of the day. Stock is hanging right around that 525 level, but you usually want to see that move above and beyond, and you want it to happen within that first day. Like you really, within that first hour, I should say, after an earnings report, not day, first hour of trading. And if I'm looking at butterflies, a lot of times, especially if you're just doing a 1x2x1, just a single 1-unit butterfly, you're looking to get out fairly quick on that trade after that earnings announcement. But I thought that was interesting to see that the September 22nd expiration did a lot better than the September 15th expiration. And this was just a great example and a great opportunity to talk about that pricing on a butterfly that's working out for us, right? So there you go. So we'll go back. I guess we'll leave that there. Let's talk about the other positions that we had on. So on Options Guy TV, we did quite a few trades on long energy, and oil is breaking a new level. It's up towards that 90 level. So we did a few trades in the USO, which is an ETF that tracks oil prices. And then at the beginning of the week, we decided, well, let's go out and try to get long in this marketplace. It is September, it is October. We looked at a VIX trade that isn't really panning out too well. Right now, the VIX is up a little bit. We see a lot of red. If you look over here on my chain, this is like the default. It's a lot of the stocks that we were looking at. We got NVIDIA, we got all this. And Caterpillar is now down about $4. It had a decent run up. It's down about 165, but we're saying, which way could we get long this market in September and October? And we just looked at a good, solid industrial company that could benefit from, once again, spending money on infrastructure. So it's just hanging out, not doing anything wrong. And we in that scenario, with why not just stay long that option contract? And we sold a call against it because we were a little nervous about the marketplace, and we actually turned that into a fig leaf. So now all we're doing is waiting for that short call to expire, and I'd probably go out and sell another call against that position until we get some momentum to the upside. The stock right now is at 278. We put on the trade, it was at 280. So it's only down $2 since we put on that trade. And then we looked at the ADBE. And now today, we're going to take that news in oil, the fact that we've hit, we haven't been at $90 a barrel in years, go all the way back to COVID, before the COVID times, since we've been really towards that $90 a barrel on the oil futures, the West Texas crude oil. And we mentioned a lot that we wanted to get long on Options Guy TV when we broke through the 80 level on oil. So now let's get short. I just thought I'd get a little crazy. And I thought, how can you get short oil, right? What would be one way to play the fact that you think oil is going, oh, I'm sorry, how could you get short some companies that are going to be hurt because of the oil prices, to reiterate that. And so I thought we would get short JETS, which is the ETF that actually tracks airline stocks. And it's got an ample symbol, so it's very well named, and it's just JETS. And the markets aren't bad in it. And it's an $18 stock, so the options are inexpensive because it's an inexpensive underlying. And if we're thinking about oil prices continuing on up, a little bit of a breakout area that it went to the 90 level, could it go back to that 100 level? What stocks would be affected by that? And a lot of the stocks that would really be affected are the price of airline fuel, which would definitely affect the bottom line in the travel industry. So JETS, that's what we're going to be looking at today. And we're going to go on out and actually buy a put, just a very, very simple trade in JETS. And I noticed that we do actually got a question here. Let me put this question up on the screen. All right. So question is, do you think the fact that Aaron Rodgers got injured will have any effect on the Jets stock price? That was pretty good. I got it. Yeah, as you may have known, Aaron Rodgers actually had an injury in his first game as a Jet. Literally within the first minute, I think, of play, Rodgers tore his Achilles, and they're saying he's going to be out for the season. So I don't think that has any negative effects on the underlying stock, except for the fact that their symbol is Jets, JETS. So go Jets, maybe. And I hope Aaron Rodgers will be doing well. Hopefully he could make it back before the end of the season, but it's highly unlikely. All right, so that's fun. If you have any questions, as you can see, put them in the chat box and we'll be happy to address them on the show. And thank you for that jocularity. I appreciate that. All right, so how are we going to get short Jets? I don't want to short the underlying stock. I would rather buy the put because of everything that I've said in that it's a inexpensive underlying. Implied volatilities really aren't that bad. If you see this right here, we're in the September 22nd expiration. We're looking at about a 19% implied vol on the at-the-money option contracts. I'm still going to stay with the seasonality. So I'm going to go all the way out to October, and I'm going to look at the last expiration, one of the last expirations in October. I think I'm going to do the October 27th, and I'm going to click on it, and you'll see that that's going to put that right over here. I'm going to do that October 22nd expiration. It's got 42 days to remaining, and I'm going to go a little bit in the money, try to get a little bit of a long delta because I'm longer term. Well, I mean, 42 days isn't real long term, but I'm going to be longer term short in oil. And if we do get that break back down and we go down towards the $85 a barrel and all the way down to bounce down to that 80 level, that's going to affect my stock and the way that I'm going to look at it. So I'm going to be looking at what's going on with oil as much as I'm going to be looking at this trade on this underlying stock. And we see today that the stock is actually up a little bit. And let's take a quick peek at the chart. I meant to do that. And just kind of show you some of the weakness in this underlying stock. Like this is really ugly in this area here. We had a breakdown. Here was where the gaps filled. We still got some downside potential by looking at the chart going all the way back to the 22nd. This is October 22nd at the just the end of the big downturn in the marketplace. We see it got all the way down to 15. We go all the way up to the highs. We're looking at around 25. So this underlying does move. It does have some volatility, very strong upside. Now all the moving averages are going the wrong direction, right? We have the 20-day crossed over the 50-day, and then it went and crossed over the 200-day, and now we have a strong downturn in the 50-day moving average. So I just think this is with all this grouping of stock prices and where it really wanted to hang out, we broke down a little bit below that area. And so why not? Why not speculate and buy a put in Jets? So which one are we going to buy? So let's go back to the trading page. We're going to scroll out in time. I'm literally going to be buying something close to an 80 delta Here we see this one, the 19 strike is trading at a 76 delta, and the 1950 strike is an 88 delta. I'm going to do the 19 strike. The markets are fairly tight in it, but open interest, as you see, is not really that big. This is the open interest. And so that does make you a little bit nervous, because as we get deeper and deeper into money and there's lower open interest, a lot of times you'll see the bid-ask spread widen a little bit. So that does make me a little nervous. But ultimately, I'm probably going to sell a put against this and roll this into a long put spread. But to start with, let's just buy this underlying. This will be the paper trade for the week. And we're going to buy the 19 strike put, which is about $1 in the money. 1805 is where the underlying stock is at. And in order to do that, all I do is click this little button, and we're just going to pay the ask for it. I don't think we're going to get the midpoint filled. Like I said, the volume's not there, so the ask price is 110. We're going to make that our price, and we're going to be buying one October 27th expiration, 19 strike put, looking to pay the market for it, which is $1.10 or $110 plus commission will be our maximum downside. And we'll come back on Monday and we'll look at that trade and we'll see where we're at. If you have any other questions, please put them in the chat box and I'll try to address them. But if not, we'll have a quick show today, but a very interesting show to see what happened. It was a real good overview of what can happen with butterflies around earnings. So I really like how Adobe reacted after their earnings report, and the trade worked out. Oh, I see another question in here. All right, let's put that one up back on the screen. In your opinion, what is the main advantage and difference between shorting the stock outright and buying a put? All right, so if there's huge open interest or short interest in an underlying stock, the puts will reflect that. They will be more expensive than the calls on the same strike line. It's a situation that they would say it's hard to borrow. And that really gets muddy when you're looking at trying to short a stock. And I just think about Tesla when it was when the company didn't have earnings and it was the most heavily shorted stock around. The puts were very hard to trade because pricing in that hard to borrow cost of getting short Tesla was really affecting the put prices. And I know that because I was trading them at that time. So in this instance, when there's not this huge open interest and you're in a ETF like the Jets and implied volatilities are around 20% and it's an $18 underlying stock, I think I find it, I don't know why I would short the stock. The options are priced fairly. They don't have a lot of juice in them. So just a great example, I'm buying this 19 strike put and I'm getting 80 delta or 76. Let's call it 77. Okay, 77 is our delta. That means that if the underlying stock goes down 1, our option contract should go up by about 77 cents. So I'm getting very similar movement by just going 1 point in the money, and I'm paying $1 for it. And I have limited risk of $1. If I short the stock, I obviously have unlimited risk on being short the stock. So there's a lot of benefits to just buying that put outright, especially when the pricing conditions are as simple as they are right now in Jets. And that's why we just got long a put. And we don't do that often here on Options Guy TV. You know, it's always people like to people like to be bullish on the market as opposed to bearish. But in September and October, I always like to look obviously at some bearish trades. And I figured, you know, we got long on oil. So what's the detriment of oil going up? Well, obviously the airlines have to pay for all of that jet fuel. So there we are. All right, I guess that is it. I see no other questions. And what a great week of Options Guy TV. Come back next week. Guess what? We have Russell Rhodes is going to be here on Wednesday with me ahead of the Fed meeting. Russell is the author of a plethora of books on the VIX. And we'll be talking about expected moves a lot, like we just did here with Adobe. and get into a lot of his research that goes into a lot of the books that he's written on the VIX. So please tune in Monday for the next Options Guy TV, but definitely if you can make a stop, come on by. You don't want to miss Wednesday's show and my conversation with Russell. All right. Thanks for coming, everybody. Please click subscribe, ring that bell, pound that thumbs up, and we'll see you this coming Monday at 11 a.m. Eastern Time for the next edition of Options Guy TV.
That was a good show.
Yeah, it went well. It went well. Well, the Adobe always good when the trade works out, right?
Yeah, and that was good.
But we've had a couple of really good butterflies that panned out. I think we hit two of them that we hit one that was dead on. I could hit the short strike exactly.
Yeah. No, that was a good one. It was good.
Thank you.
Good reaction to the pre-planned question too. That was good.
Yeah.
Cool. All right, cool, Brian. Well, I know you. Good luck with your endeavors for today, tomorrow, and your weekend. I know you're going to be busy now.
Oh yeah, I'm gonna be working a lot just through the weekend. So.
Yeah, awesome. We'll see you on Monday. It's going to prepare for the next installment coming up now. But cool, Brian. Well, yeah, and then if anything comes up, just shoot me an email, and I'll talk to Ruben, see if we can maybe figure it out to to run an experiment to stream the Russell show to your X on Wednesday. That could be really cool.
And I will try. I got to go in and try to find another snippet of one. I've kind of been slacking on that a little bit.
Yeah, if you can find the snippet today, that will be good. Yeah, then we can get it out by Monday.
All right. Where do they go out? Where do they go?
Well, we produce them and we put them on the folder system for marketing. So if you find something that is kind of like not time sensitive, if there's anything today, because then they're there. So they have quite a few clips that they're going to start to rotate through things.
So they're not doing. They haven't done anything with them yet.
Not yet.
Okay. So, I guess that's what the question was.
So they're on the lineup for them to do something, and then there's another company that Dan has hired to do marketing and PR. So they're going to be using some of the shows, and they're going to be cutting things out. So we'll see what happens. I think Dan is super hyper focused on the marketing side of things.
All right.
Right now. Cool, Brian. Well, have a great weekend. Good luck, and I'll see you Monday at 11 Central. No, 11 Eastern, I guess.
Eastern time. There you go. Yeah, but I'm still surprised. I don't know what to do about the chat box and the fact you can't do it in the hub. It always makes it weird.
Yeah, we'll run an experiment because I want to try something out. I don't know how we're going to do it, but we have to start streaming into sessions, which would effectively could be streamed into your profile inside of the hub.
Okay.
And then there, if anyone goes there, then anyone can chat. They don't have to be on YouTube.
Okay.
So now we'll see how that works out.
Coming up with an answer to that problem.
Trying to figure it out. They put it on the back burner for now because the marketing is more pressing thing, but I want to figure it out. So I'll see how much time we get and then try to figure that one out because that's important, I think.
Yep.
Yeah.
All right.
Cool, Brian. Well, have a good weekend.
All right. Sounds good.
All right. See you. Bye.